Hello, guys. What is happening? And welcome to this live stream. We are back. So it is great to be back, and we are going to be going through now the yield curve a little bit and what's going on, some of the moves in the corporate debt market that I think are incredibly important to observe. All of these things point to one thing and one thing only, that is a recession that is coming. So we're going to check into these different things. So I think Russia gets cut off SWIFT today, volatility Monday. I don't have a clue about that. I'm sorry, you might be right. Yes, we are live, Greg. You're on the screen. There's usually a delay, though, from when I speak and when you guys hear it. There's always a delay. It's always YouTube and whatever happens. So, anyways, we're going to get into this. So, first of all, what I want to take you to is this, which I posted on my Twitter, is and this is incredibly important. The 2-year note has one of the biggest weekly jumps since 2008. What happened in 2008, guys? You don't have to be a brain surgeon to work all this stuff out. Like years ago, 2020, 2021, I think as well, we were hearing a lot, biggest move since 2007 and everything like that. So this is really, really interesting, these moves, because now you're seeing biggest weekly jump since 2008. The Nasdaq biggest sell-off in January since 2008. Was 2008 a good year? I don't think so. So it's just all the warning bells are going off and nobody really is listening. And this just really sums it up nicely, in my opinion, that you're getting literally for like 0.004% more on a yield to hold for 10 years than 5 years on a treasury. Now, obviously, we know that most people who buy treasuries, apart from the banks, aren't holding them till maturity. They're actually buying and trading them for, the price swings that happen within treasuries. So if people are thinking that the long-term horizon things are going to be bad, then they're going to hold on to those long horizon treasuries because they might yield more than rates will in the future. So that's exactly why that happens, and it's such a good indicator of a recession. And Jeff Snyder is much more of an expert than I am on this. Like, I don't claim to be any expert on this at all, in fact, or anything for that matter. But the thing is, I just think logically about these things. And, the fact that the 5 year is selling off, the fact that the 10-year is not, that's a big thing. And by the way, when I'm talking about selling off, I mean the reverse. When I'm looking at bonds, in my broker, I'm always looking at the price of bonds, not the yields. I don't trade the yields. I don't trade bonds, by the way, just to be clear. But when I look at bonds within my broker, it's always going to be the actual price of the bond. So this all goes in reverse. If yields are going up, that means bond prices are going down. They're selling off. That's important to remember, because when you look at the junk debt and the high yield corporate debt, that'll make more sense to you. But yeah, it's incredibly interesting. And I'm not sure I put anything. Oh, yeah, look, I posted this as well. So this was 5 months ago. And defaults among low quality companies at 2007 lows. And people are like, fantastic, absolutely fantastic. But the thing is, people don't put two and two together. They don't, when they see the inventory levels are at the lowest point since 2007 when they're looking at real estate, they don't think anything of that. Oh yeah, whatever. What happened in 2008, guys? These things always hit record rock bottoms and then fly off the other direction. There's always going to be a bottom or a top to every market. I don't care which market that is. So there's always going to be that. And when you get to those tops and bottoms, you get reversals that happen. And they typically aren't just like a couple of steps, they're typically big reversals. So this is incredibly interesting that junk debt, only 5 months ago, defaults were really low, and what that would have put us in September, October. So it's very, very interesting anyway. Um, so yeah, it's and then the rest is just about Trudeau and stuff. So anyway, if you want to see that stuff, you can just go follow me on Twitter, Market Mania CA. But anyway, that is what's happening there. But what I want to take you to is the 5-year, because it has inverted in Canada. So let's get across to that. Oh shoot! I know this is gonna. I knew that would mess it up. Hold on 1 second. Let me get rid of that. Share screen. Tab. 5-year. Here we go. All right, fantastic. Okay, so now you can see the 5-year bond right here, but what we're concerned about is this yield curve right here, which I'm zooming in on the wrong thing here, getting it all wrong. So let's zoom in as much as we can. So here is the yield curve, and as you can see, it's inverted. It's started to drop off here. And if you just look, I think Market Watch really gets this really good, and it shows you well, because it shows you a year ago what was going on, so you can kind of understand more what's going on. So this line right here was a year ago, and you can clearly see that yields were going to be rising, which means that the economy is predicted to be, I mean, there's some flattening, don't get me wrong, which means growth slowdowns, and this flattening right here is not a good thing either. But if you look at this now, it's really showing you that it's flattening and then inverting. So that is not good. That is a big, big predictor of a recession coming. So it's like a 90% probability when it comes to the yield curve. And the funny thing is, well, it's not funny actually, but before 2020, the yield curve inverted as well. And it may not have been predicting what happened with the cerveza sickness and everything like that, but it was predicting a recession that was coming. And I've talked about this in other previous videos, that there was a recession. People were saying about recession before 2020 hit, and everything started with 2020. This is part of the reason which I sold most of my stocks during December of 2019, and I don't claim to be, but everything was just lining up for a recession. Growth was slowing down, and the yield curve was inverted. So this is a very, very good indicator. Very, very good indicator. David Rosenberg is calling for a recession in June, July. Yeah, I've seen that guy. He seems like a very knowledgeable guy, and seems like he's got his head in the right place, unlike most people. So I believe it. Vancouver ends mask policy today, April 8th. No more passports. Wow, that is fantastic news. Really, really great news. And I think as well, at some point, Ontario is ending their mask policy as well. I know I mean, Ontario's had it the whole time, but BC and Alberta have been in and out of these policies constantly. Like BC dropped the mask policy, and then Alberta dropped it last year, and then BC brought it back in, and Alberta didn't. All I can hope is that this is the end, that this is seriously the end. And the way they're focusing on Russia and Ukraine, it seems like it's going to be the end. So I think options expiration were today as well. Just thinking about the guy that says about volatility on Monday, but volatility is there already, let alone Monday. In certain markets, stocks have absolutely collapsed. Stocks like Peloton, Zoom, they're back down at pre-Cerveza levels right now, before the health crisis and everything like that. Some people have just been destroyed, just absolutely destroyed. Like they're looking at 70% losses. And there's a lot of people who bought into these hype stocks. And I don't buy into these hype stocks because they don't pay you anything to own them to start off with, and they are far too volatile for me. Way, way too volatile. So, but people just they love them on the way up, hate them on the way down. So it's very, very, very Greg, that is a fantastic question. I probably don't have a really great answer to that, but I would say here's what I would describe as a depressionary environment, and we're sort of heading into this already. Is basically if we have what I said earlier, which is you get persistently high inflation, a recessionary environment where people are losing their jobs, asset bubbles are collapsing, that to me would constitute a depression, because then you've just got all those forces converging on the people that have lost their job and everything like that. Like they're being hit by high inflation, all these different things. The price of their home, if they own one, is going down in value. So it's really, really that I think it's like a stagflationary recession, which we haven't seen in so long, like 30, 40, even you could argue 70 years. So the thing is, I think it's likely with what we're seeing right now, because if you look at inflation and how it cycles, inflation doesn't just come and go in a couple of years. You have ups and downs with inflation. And what happens with inflation is it lasts generally at least 5 years. So if you say that we started in 2021, then that means that we're not going to get done this until at least 2026. And that's just using history to sort of look at what could possibly happen in the future. And I can see why that happens, and we can make logical sense of that. Because if you think about it, when prices start to rise and businesses starting getting used to putting their prices up all the time, like it takes a long time for all that to reverse itself. Needless to say, it still could. But I think the fact is that currencies, you're definitely seeing currency wars that are breaking out now. The Russian ruble, a lot of people are looking at the Russian ruble and they're saying, oh my God, like good that their ruble is collapsing. But what people don't realize is that could happen to any currency. And, you know, that was happening to the Turkish lira. It probably still is happening to the Turkish lira. I don't know where the Turkish lira is trading at right now. We'll look in a bit, actually. But the thing is, um, if there was a financial crisis in Canada, that would trigger a massive sell-off in the Canadian dollar, which would just further increase inflation, even if prices were actually going down. So you could have the value of the currency dropping so much that prices are actually going down, but they're not, if that makes any sense, because the value of the currency is going down even more than prices are going down. So prices are actually still going up. And I think when you start to have those stagflationary sort of aspects happen, I think that's really the depressionary sort of environment. And it already feels like we're on the edge of a depression. And a lot of people were saying, and the thing that I mean, this isn't to be doom and gloom, by the way. I'm just going to hold my hands up and say that I don't even like to think down this rabbit hole because it gets seriously dark. But the thing is, QE and all the stimulus and everything that the government did, it doesn't stop what's going to happen. And a lot of people were saying we're going to see depression, and we had depressionary levels of unemployment. And the thing is, all that did is buy us time and make asset bubbles that make things even worse. So, arguably, to some people like Jeff Snyder, you could see it actually being worse, like worse in his view than before, because he believes that all these things don't actually stop the recession. And I don't believe they do either, but they just buy you time. And he's a lot smarter than I am. So you should definitely check out him and Emil's podcast. It's on Spotify. Emil is also on, and I think Jeff is as well. They're also on YouTube, but they're fantastic guys, way smarter than I am, and you should really listen to them. But yeah, it could seriously happen, and that's not something I say lightly, because that is a depression is not something anybody would wish on any person or nation or whatever, no matter what happens. So anyway, I've totally lost where I was, but we were with the yield curve inverting, so you can see here it's inverted. Now, the interesting thing is, there was something else that I wanted to go through here. Was it uh, New Zealand as well? New Zealand is really difficult because for some reason they don't do a 30-year, or at least they don't have it on market watch. So that if you look at their yield curve, it just looks bizarre. It just really thinks everything is absolutely insane. So we're going to head into junk debt now, which I think is incredibly important, and we'll tie that into the bankruptcies that are happening. And then I've got the story. I forgot about that. So we got a super chat. USB in first try. You sent one the other day. You don't have to keep sending super chats, but thank you so much. That's very nice of you. It shows that you really appreciate this. I think housing prices will just level off and everything else will hyperinflate. 10-year commodity bull market ahead, food up 200%, silver $300, gold 8K. You could be right, but then housing prices aren't going to be leveling off, are they? They're actually going to be going down in real terms. And that's what I've tried to say to people on here is how housing prices in a situation where you've got David's on from New Zealand, in a situation where you've got housing prices that are going up at, you know, no, I mean in a situation where you've got food going up. I got pulled off side there with David. Um, in a situation where I'll try this again. In a situation where you've got food, silver, gold going up, which could happen, it's a distinct probability, because the central banks I am totally in agreement that the central banks cannot control inflation, even with their interest rate hikes. I mean, they could if they got back to real interest rates. Do I think we'll ever get there? No, because they would have to bring inflation above 5-6%, which would absolutely collapse everything, and that's never going to happen. But the thing is, because housing is such a long sales cycle, it's not very liquid. If prices are going up like 50% per month of food and gas prices and everything like that, like commodity prices are exploding, housing prices can't keep up with that. And as we're seeing right now happen in front of our eyes, housing prices are starting to level off. They're starting, it's starting, and we've had one hike of interest rates. And the reason why housing prices aren't tied to inflation is because they're leveraged. They're highly leveraged products. So the thing is, there's a lot of different things that affect housing. And but yeah, I think gold 8K. Yeah, I mean gold is going to get to 8K in my lifetime, I'm sure, and it may even get to $100,000. I'm extremely bullish on gold. Now that doesn't mean that it might not go down, and correct in the meantime, but I'm extremely bullish on gold and silver. Gold and silver, I don't think are going to be going down, and there is a lot of supply that has been took up of gold and silver. So that was a fantastic super chat and fantastic to get into. Exactly. David, you are from New Zealand. Correct me if I'm wrong. Let us know in the chat what's going on. We just did a live stream about what Bloomberg is saying, and it's fantastic. Can you give us your best educated guess of how you currently think the next year is going to go for Canadian housing? Well, put it this way: I can't tell you exactly what's going to happen. All I can tell you is probabilities. of things happening, and then you can kind of work out as things unfold, because I don't know how things are going to unfold in the future, which way they could go. So let's talk about interest rate hikes. Number one, the probability of housing prices coming down with every interest rate hike just keeps increasing. So the more interest rate hikes you get, the more chance of housing prices coming down you get. So if you start to see that policy reverse, then you know what's going to happen. Like, prices, they might not necessarily go up, they might flatline, whatever. But in a situation, let's say they actually get to 1.75%, which the bond market is predicting, which would be as high as it was before this. So, as we know from the private debt, which I'll bring up here because I still got it up here, we're getting some amazing questions tonight. Really fantastic. So, I'm going to pull this up for you. So as you can see, 2020 debt absolutely exploded, and we're probably going to see a new high. We're looking at December 2021. We've had huge spikes in prices in January and February across Canada. And since that hike, a lot of market activity is starting to change course. You're seeing more listings come on, less sales. That dynamic is changing, and you can look at Better Dwellings article. We went through it actually on a live stream the other day, but you can see that, as we saw with New Zealand, household debt has gone up, and that is why, if we actually get to the same interest rate we got before, housing prices, I believe, could go lower within the next sort of 2 to 3 years than they were before this all started. So think about some of those losses. And that would collapse the whole housing bubble if that happened. So then they would fall even further, all the way back to the trend line, which, trust me, not even going to mention because people will think I'm an idiot. But that is seriously a big, big risk. And that's the thing. The more housing prices correct, the more chance of this bubble popping. And the more interest rate hikes we get, the higher probability of prices coming down. So that's really what happens. But yeah, it's people are expecting a crash normally, though. I don't think it will happen. The thing is, I don't think anybody's expecting a crash right now. I really don't. Just look at the amount of people that have been buying houses over January, February. People just they aren't expecting a crash at all. They're betting against interest rate hikes. They're betting against everything. They don't know. They're not realizing the risk that they're taking on, but they are betting against interest rate hikes. Now, they've already been proven wrong because the rate hiking cycle has started. So I don't think a lot of people are expecting a crash. You know, if a lot of people were expecting a crash, this channel would have a way more subscribers than it does right now. At least I think that's the way it would work. But the thing is, I just don't believe that a lot of people, that all the people I speak to, are just expecting housing prices to continually rise, and that is the consensus. That's why there's still so much FOMO out there. So we've got so many interesting comments coming through. I'm just starting to go. So David is in New Zealand, so his comments are going to be incredibly interesting here. I've seen this view. Firstly, New Zealand provides a great advanced view. Housing prices are on the verge of collapse. Last year, my friend in Auckland was thinking of putting his house on the market for 2.2 million. Now he's hoping to get 19 point. Oh wait, he's corrected. Correct. Canada and New Zealand, 4 to 6 months. Yeah, I agree. 2.2 million. Okay, from 1.8 million. I was gonna say that that would be a hell of an increase in 4 months, and provincial centres down 6% in 1 month. So there you go. And is that where the populations are? Because New Zealand is ahead of Canada, and really you got to look to what's happening in New Zealand. Forget what's happening here at this point. and just look at what's going on in there. Because as we discuss, when you dive into the economics of this and you look at the household debt, let's bring up New Zealand again. You can see, and I'll zoom in on this so you can see it better, and then we'll get into more of your comments. Canadian real estate shows in the house too. God, is that showing better? Oh, it's because I haven't got enlarged it. So this is New Zealand household debt to GDP. So this is the amount of debt that households have. 98. Let's go to Canada. 110. So what that tells you is Canada has way more debt. So not Canada, Canadian households in particular have way more debt than New Zealand households. And that's, well, not way more, like 10, 15%, but that's still a substantial amount when you're talking about the levels. So little interest rate hikes actually make a bigger difference than people think. Now, I don't expect that 25 basis points is going to do anything, but like when we get to 0.75% like New Zealand, I think that could do something. And I think if the Bank of Canada pulls a surprise out the bag in the next meeting and does a 50 basis point hike, I think that people are going to seriously panic. A lot of the people that are over leveraged. And the thing is, it's like we've talked about, you have to really look into what else is going on. Because if you haven't seen the video I did about 2008 and how Canada avoided that, you need to go watch that video, because in that video, I go over private debt. And private debt is incredibly important, because private debt is your businesses. It's the companies that you work for, the average Joe and Jane that they work for. And they are highly in debt. So because they're highly in debt, they're equally, if not more, exposed to interest rate hikes. So interest rate hikes lead to defaults of corporations and lead to bankruptcies, which we went on to in the last, but for the benefit of those people that didn't see the last live stream, we'll bring it up right here. This is bankruptcies in Canada. And as you can see, on a long-term 25-year chart, it doesn't look that bad right now. But then if you pull it up and look at a 1 year, it starts to look a little different. Bankruptcies are increasing significantly. And does that line up to when interest rates and yields started rising for corporations? And it does. It lines up with them exactly. It was in September when the yields started exploding on the Canadian bonds, which then mean that corporate Canadian debt, they then have to pay more to service their debt. That means there's more bankruptcies. So to me, it really looks like we're starting to see a reversal. And if I pull it to this chart, oh, we're on the line, but you can see, like, we bottomed out in 2020, I'm guessing, yeah. And we've been up and down a little bit, but not much more. And we finally broke out this range and we're heading upwards. And this is one thing that we're going to have to continue to monitor. But my prediction is this: if we continue to see this bond rise like we're seeing, and other bonds rise on the short front, and corporate debt sell off, which is what we're seeing, then you're going to see more bankruptcies, because these businesses are in more debt now. And a lot of them are insolvent anyway. They've just been surviving on all the stimulus that was handed out by the government. And this is the thing about all this government stimulus. Like, it's, in a lot of ways, it's just burning money, because you're throwing money at companies that are going to go bankrupt a couple of years down the road anyway. You're just literally starving them off so you can get the pervasive sickness out of the way. Oh, it's all open, everybody starts going bankrupt, and then the recession starts. So incredibly interesting. I'm just trying to go through some of your comments. Okay, so this is interesting. Canadian real estate show. I know I think they're both realtors that do this. They do a podcast. I'm actually going to be on there tomorrow. No, Sunday. Let me get that right. Looking forward to that. But everyone is super confused right now, as I could imagine. Like, because And what are realtors and mortgage brokers going to be telling people? And it's like we've discussed on these live streams before. It's pretty obvious what most of them are going to be telling people. Hey, you need to lock in that rate. Lock in that rate right now before rates go higher. Of course, they don't realize that the probability of prices going down goes up as interest rates go up. They don't realize that. They don't realize that statistically, when rates are higher, affordability for housing is much better than when rates are lower. So when you see interest rates going down, it's actually things are getting more expensive. And when you see rates going up, it's actually when things are getting cheaper. And that's the flip way round thinking that most people don't have. And I seriously believe we've reversed the course in monetary policy that may come to fruition over this year, which is the interest rates are going to go higher because the central banks have already come out. They've already said that we're going to be using our tool. It's one tool, guys. It's interest rates. We're going to be using that tool to bring down inflation. You, me, and the fence post all know that ain't going to do nothing. So it's still bananas in Toronto. I think, yeah, and that's still going to continue at least until they get a couple more hikes in, I would think. But I would think that more supply is going to start to appear. At least the smart money is going to start to exit because people who have any knowledge, and you don't have to be a brain surgeon or a rocket scientist to work it out to see the writing on the wall. And yeah, anyway, it's incredibly evident. Yes, this is very, very true. And this is one thing Canadians do not understand at all. And I understand completely because we were on the lending side trying to borrow money in post 2008 world in England. It wasn't even the US, it was England. And the thing is, when lending conditions change, everything changes. Everything's up in the air. What people don't realize is banks' prime rates can just change. They can just change. Even if the Bank of Canada doesn't raise rates, if the banks see significant risk, they will raise their prime rates. And that happened in 2008. And a lot of people got caught out in adjustable rate mortgages. I mean, people are taking huge risks and they're not even looking at the risks. A lot of people are just blindly like accepting prices only go up. This real estate only goes up, and that's it. And you really got to look at the fundamentals and boil it down to fundamentals because wages still are fundamentally what underpins real estate, even though it doesn't look like it right now. Because in Canada and in many countries around the world, there is a real estate market that is built out of a house of cards, and that house of cards is leverage. If you can have people take out leverage on leverage on leverage, then that is increasing the money supply. But we're thinking in that different way where I talked about it in my how money is created video, which is money supply is debt now. It's not like it used to be. So new money entering the economy just means more people are getting into debt. And it means eventually that money supply will decrease. And we will see that when the debt starts to get defaulted on and it starts to contract, gets wiped out. So, Greg, since the stock market is more liquid than house prices and changes daily, hourly, how would we see the stock market take a dive first? Well, if you look at the stock market, if the stock market goes down and stays down, then it can have an effect. And the stock market, a real sell off, and we're not in a real sell off right now because certain things aren't going down. Value stocks aren't going down. I have a long shopping list of stocks that I would love to buy, and they aren't going down. In fact, quite the contrary. A lot of them are going up. So the thing is, we're not in a stock market crash. The hyperinflated Nasdaq stocks and the tech bubble is bursting, but as for value stocks, they're not really crashing, most of those. So if we saw an actual full sell-off across the board, everything, then yeah, because as we'll see in a minute, sell-offs do impact different instruments when they happen. So like corporate debt, junk debt, yields, mortgage-backed securities. You have to think a mortgage-backed security. Let's just talk about what a mortgage-backed security is real quick. And I'm sorry if I'm boring the hell out of everybody. There is so much stuff happening in the chat, which we're going to go through. But mortgage-backed securities are essentially mortgages pulled into a product that is then sold to investors, and investors get a yield on it. It could be a bond. Let's just call it a mortgage bond. So they sell this mortgage bond to investors. But the thing is, in a broad market crash, the prices of those mortgage bonds, they also start going down. And as we discussed before, that means yields go up, and that means risk goes up, and that means bank interest rates go up, even if the central banks are lowering rates. And that's exactly what we saw in 2008. And we'll see the same here in Canada. No doubt, no doubt, we will see the same thing here in Canada. Even though the government backs all the mortgage-backed securities and everything like that, I guarantee you, when all this starts happening and it really starts crashing, the government, the CMHC, is going to suspend its AAA rating on mortgage-backed securities. And then the interest rates are going to skyrocket. And the reason that they'll suspend putting that stamp of approval on there is because essentially their liability for the calamity and crisis that will be incoming will be so large, they'll want to limit their exposure as much as possible. And they've been trying to limit their exposure actually since 2017, because they've realized that the taxpayer, the Canadian taxpayer, has a massive, massive liability towards all these mortgages. And it's no different to similarly what happened in 2008 in the US. Who ends up bailing them out? It's the taxpayer that ends up bailing them out. And it ends up in austerity and all these different other things that are kind of what you touched on earlier about depression, Greg, like when you've got cuts to public services, inflation is going up, asset prices are going down, immigrants are leaving, demographics are falling apart. That would be a depression for Canada. And that wouldn't be something that quantitative easing could solve. It would be a 10, 20-year thing, and it would be sustained. So, and I honestly believe a Japan style crash is what Canada will end up with. The bubble began, David. What time is it in New Zealand? Let us know in the chat. It's got to be early morning, I'm thinking. Saturday morning. You're ahead of us, right? The bubble began in Auckland in 2015 and spread out progressively to the provinces. Yeah, so the bubble really started in 2008 here in Canada. So it's been going a lot longer, but I could say the super cycle, the super bubble really started in 2015 as well. That was when housing prices really exploded. And then there was a slight correction in certain markets, and one of the mortgage lenders nearly went under then. And the Canadian dollar was tanking, and nobody noticed. Everybody's forgotten about that. Just brushed that one right under the carpet. And that was whatever it was, peak to trough. I think it was like 20%, 15-20%, if memory serves right. In Toronto, housing prices went down in that correction in 2017, and actually what happened in the suburbs were prices went up. So it wasn't even like a uniform thing. And Home Capital Group basically had to be bailed out by the Ontario government. And when that happened, the Canadian dollar hit a massive low. Investors know what's coming, and that is expressed in the yield curve, and it's expressed in the Forex market where the currency is right now. Two markets that I don't believe, at least on the long end in terms of bonds, are manipulated by the government, especially the Forex markets. And the New Zealand dollar is another example of that. If you look at the New Zealand dollar, it's been doing incredibly similar things to the Canadian dollar, wouldn't you believe? Um, what is the New Zealand yeah, we never hear about the New Zealand stock market, so I have no idea. So David says, why is that froze? It's come back quite substantially. Certain companies are back over 30%. So David, what sort of companies are in New Zealand stock market? Is it mostly commodities? Is it like tech? I think it's really only England, US, which is like the tech boom. Even though there's some Canadian companies like Shopify that been in a massive just hyper valuations and are coming back down. And I'm sure there's plenty of people that are buying them on the way down, thinking I'm getting myself a great bargain here. I was really smart when I came in and bought stocks in 2020. Here I am buying that dip. And I tell you, some of these stocks people are just going to be destroyed on. And just look at Zoom and Peloton as an example. They've wiped out 60-70% of their valuations. Don't we need rapid interest rate hike to prevent the hyperinflation that would remove USD as world currency? Wow. Well, we could seriously get down a rabbit hole about that. But eventually, the United States dollar is not going to be the reserve currency of the world, but it will be for the foreseeable future. um, the rapid interest rate hikes in the United States. I mean, yeah, like no, you wouldn't need rapid interest rate hikes because a lot of the inflationary pressures are not from what the Fed has actually done. They're from, well, they are from the Fed, but not directly. Like the supply chain issues, yeah, they were caused by all the stimulus that was pushed out and everything like that. But now what's happening with the sanctions and everything like that, which is causing further inflation, these are all things that the Fed and the Bank of Canada cannot control by raising interest rates. Now, if they went to real rates, then yeah, you could argue the point that they could control inflation. But let's just be real about that. To get to real rates in the US, you're talking about like 9% now. Like 9% interest rates would just send into such a massive depression. The US would be sent into such a massive depression if it went to 9%. Nevertheless, it may be heading for that anyway. But yeah, it's you've got to get to a point where people actually say, hey, I'm going to save money because I'm getting a great rate return saving money in the bank here. And that's only going to be when you get positive real rates, which we just don't have anymore. Housing will have company stock markets will collapse in 2022 and continue doing so for years. Yeah, I kind of agree with you there. What's happening in the stock market we're going to get onto in a minute, which is actually a perfect segue into I'll come back to all your comments after we just go over this. But basically the stock market has been obviously up, down, up, down, up, down, intense volatility ahead of the Fed meeting where they're going to hike rates. But one thing I want to take you through is this is high yield corporate bond ETF. Okay. So this is basically corporate bonds. This is corporate debt, essentially, what we were talking about before. And as I said, when this goes down, the yields go up. So this yield right here, that actually goes up when the price goes down. So when you have the price going down like it did in 2020, guess what? The yield goes up. And that usually happens when there are liquidity issues within the market, like we're starting to see right now. Now, the thing is, if you think about it, look where this is right now. It's actually below what was in 2018, which I think was when the interbank lending rates. Come on, get it, Luke. The interbank lending rate spiked. I was going to say striked for some reason. But if you look at where it's going now, like it's going back down to 2015 when or 2016 when oil prices collapsed and everything happened then. Like it's this going down to this level right here when you've got the amount of debt that you have in the system is going to create massive defaults and bankruptcies within corporate debt. So this going down is a bad thing. It's really, really bad. And it usually happens when yields are going up. So when you see like treasuries going up and when you see bond like Canadian government bonds going up, you know that corporate debt yields are going up as well. So that means that consequently they're selling off. And if we look at junk debt as well, this was a good one which I posted on Twitter, and I'm sorry, that's really, really not that big. But you can see again, like we're falling down towards 2020 levels. And if that had been left for long, then loads and loads and loads of bankruptcies would have happened. So think about that because it just means what are they going to do? Like the central banks have their arms completely tied up. Like what are they going to do? Rapidly high inflation, they've got to act like they're doing something. They have to, because what is important to them is that they keep some form of not in I don't want to say integrity, that's the wrong word. Their reputation remains intact. That's what they want. So they will raise rates because their reputation is more important than you losing your job or losing your home. And the politicians don't give a flying, I want to use profanity, about any of us. They don't care. That's become evident with just looking at what they're doing the gas tax right now. We're not going to take that money off your we're not going to hold off the carbon tax. Screw you. Like they don't care. They really don't care. They will just keep raising rates, and I see them doing this because they've got to look like they're doing something about inflation. And until those inflation pressures go away, until inflation looks like it's coming back down, I really don't see them stopping with the hikes. So we got a toxic cocktail now that's mixed up because you've got all this happening, then you've got rates going up, like it's creating this toxic cocktail. So it's really, really just bad indeed. So, but yeah, these tickers, J and K, and the other one here, which is HYG, add them into your watch list and then take a look at what's going on with these. Make sure you're paying attention because, imagine if we get down to 77, we'll be cruising below March 2020. And what happened then? Was it good? Just think about it, guys. When this was going down, was it good times for the economy? No, no, it wasn't. And it's going down right now. So it's not good times for the economy. And it looks way more sustained because it's not happening as fast as it happened in 2020. I always say, it's especially true when I'm trading and everything like that. If you see a massive spike off the open, usually what is followed is a massive decline, even if it continues higher, because these huge moves, which happen in a very short space of time, people see them as a great time to sell. Let's get on and sell. We got a big position to sell. You've just had a massive spike. Let's get rid of it. Now, that is contrary to what most people think when trading because they see a massive spike in price and they think, oh my God, like this is going to go parabolic today, which they might be right about, but they're thinking way too long term. Whereas I'm thinking, hang on a second, I've seen this far too many times. You get this 150-point spike off the open in the Dow, for example, and then you short that thing down, it goes all the way back down pretty much 150 points, and then yeah, it could bounce off and go up 6, 7, 800 points. Usually it actually goes down to below that 150 point, so it takes out everybody's stop losses. But we're not going to get into trading here. I don't want to get into that. We got far too many good comments coming in, so let's start bringing these up and then we'll wrap it up. So Where was I? How does AB and Sask look in that comparison with bankruptcy? Also, what types of businesses in those provinces? I mean, Saskatchewan is kind of commodity based because it's a lot of farming, agriculture. They also do their fair share of oil and natural gas as well. Alberta is the same for the north in terms of energy companies and everything like that. But what people forget is like Alberta's at capacity right now. So like the oil boom that's happened in the past just isn't happening this time. Like the energy companies are just paying out all the money that they're making to investors. They're not reinvesting it in new drills. They're not reinvesting it in their own people. They're not doing anything like that. So there's no boom here. And it's highest unemployment. Places like centers like Calgary are often Calgary is kind of the place everyone looks. And you drive around, you see what I see, which is just empty offices everywhere, high unemployment, everything like that. So I don't see those in good places. And the thing is, Alberta in particular has one of the most has one of the highest household debt um, household debt ratios. That's the word I'm looking for. So Alberta, a lot of people, households are highly indebted in Alberta, which isn't that surprising, but they are. So they're at risk as well. And, we're already starting to see foreclosures popping up here, there, and everywhere. And how is that happening? Like, you've got to ask yourself that question because I was even thinking about it when I posted what happened on Twitter, which was these two houses that got listed in a place called Cochrane, and one was a foreclosure and the other wasn't, all within a week of each other on the same street, and the foreclosure was priced like $175,000 less. Now, the thing is, you got to ask yourself, why don't they just sell? But if they've already gone into so much debt using their house as an ATM and their situation is just screwed up, then people are losing the houses. And maybe they were already in a mess because of what happened in 2020. And, they were part of the deferral thing. So it's incredibly interesting, I think, what's going to happen in these two provinces. Now, I don't really know what the downside is going to be, but it's still going to be substantial. It's not going to be as much as places like Toronto and Vancouver, given, but it's still going to be substantial amounts of money, like 30%. But places like Toronto and Vancouver, they could easily take a 50% haircut and they would still be classified as in a bubble. So that it's just kind of scary because there's a lot of risk in those markets. People do not price that in. They've become just accepting of that. And I think that's really something you only see at the very top of these financial markets, is when people start to accept that this is the truth and this is what's going to happen. Like, prices are always going to go up, Luke. What you on about? People have been saying it for 40 years. The sky's blue, prices are going up. The sky's red, prices are going up. There's always an excuse, and rarely does it have any actual substance to prices, which is always funny. And they fall more than housing, but rebound sooner. Yeah, the stock market, you're right about that. But I do believe we'll eventually see a sustained sell off in the stock market, and the stock market will stay down for at least a year or two, just like it did in 2008. And that's what you really got to look out for. You want to see the stock market go down and stay down. And, parts of the stock market are going down substantially. And will they stay down though? Well, we're going to have to wait and see how the events unfold over the next years. The funny thing is, guys, when I do it live, like if I mess up, I mess up. There's no going back on it. I can't retract my words and everything. So sometimes I say stuff that doesn't make sense because my mind is trying to process what to say and I can't get the words out in the right way or whatever. And anyway, it's just funny. Um, one is a realtor, one is developer. Oh, that's good to know. Real estate brokers, etc., sell mortgages, so of course they have a rosy view. Ask a pie man if pies are good for you, and see what they say. Yeah, that's true. That's very true, because you've got to ask yourself, like, what's the interest that this person has? Like, do they have a financial interest in selling me this product? And most cases, they do have a financial interest. Now, I'm not saying that these people are bad people. A lot of them are, don't get me wrong, especially when it comes to realtors. No offense to you guys out there. But the thing is, it's really, a lot of them are just money hungry people. Now, there are a few that care about their clients, and they're very difficult to find. And the ones that care about their clients are the ones that generally do well, because they see that repeat business over and over again, because people actually trust them. But there are so many sharks in the mortgage industry and the real estate industry. And a lot of people, even the good people, unfortunately, they don't even realize, on a subconscious level, at some level, they have to believe that prices are only going to go up in order to keep selling that stuff. So, even if they're like somewhat justifying and saying, yeah, I kind of get the point of view that prices are going to go down, in the back of their mind, they're thinking, prices are going to go up, though. Prices always go up. Like, that's the notion that they have to tell themselves in order to be able to be a good salesman. Otherwise, you're just not going to be a good salesman. Now, the only good realtor that I know that's actually telling the truth, calling a spade, is Scott Walters, who we've had on this show many a times. But maybe we'll get a couple of people off the Canadian real estate show on here as well, because that would be awesome to get another perspective. I think getting everybody's perspective on this is good, so you can kind of analyze and see what you think. I'm all for that. And analyzing people is what I've done for a long, long time. I think when real rates are negative, the Canadian house is going up, but relative higher, lower, negative real rates, prices will slow down. Yeah, but relative higher, lower, yeah, I get what you mean. So rates going up, prices will slow down. Well, I think prices will go down, actually. I don't agree with that, Jason. Agree to disagree there. But because of what's going on in New Zealand, I think it's clear to me that once you get to a certain point with rates and it's still going to be negative, you're going to start to see prices come down, because it really doesn't matter to people whether rates are negative or not negative, because that really has no bearing. It's to do with their wages. People are focusing too much on inflation when they should be focusing on people's wages, and people's wages are negative. So it doesn't matter that inflation is rocketing. Now, I would agree with you if wages were keeping up with inflation, which they are just screaming miles behind. And if you add into the mix, high gas prices is going to take 1% off people's income, they're deeply negative. And that just shows you how you can end in this stagflation recession, where real wage growth is like deeply negative, even though it's positive, just because of inflation. So, and that's really what's going on. Okay, sorry, I'm a bit down. All right, okay. Robbing Peter to pay Paul. German Jesus. What the? Yeah, pretty much. Last year, mother bought a house. She's as pleased as punch with for 760,000. She visited a neighbor who has a appreciably bigger, nicer house bought 2 years earlier for 530,000. Now that's some inflation. This is in a provincial center with an average income. Yeah, it's just absolutely insane, isn't it? That's just what happens when people are allowed to leverage upon leverage upon leverage upon leverage. You just see prices explode until the leverage stops, or the debt costs of servicing that debt get so high that people can't even afford those. And I think that's what we're pushing into right now. Yeah. Right now, you get the worst quality of home per dollar spent in Canadian history. Yeah, totally agree with you. Houses are fairly valued by general agreement of at 3 to 5 times income, so 15 times is looking a bit expensive. 22 will see house prices collapse. I urge anybody to pay close attention to New Zealand's unfolding developments. They are a free to non-NZers look into the future. Exactly. Yeah, David, I totally agree with you. And every month, I think we'll come back here and see what's going on in New Zealand. And it's going to be interesting to see if they keep hiking. You know, they just hiked about 2, 3 weeks ago again, and prices were already sliding before that. So I think things are just going to get worse. Um, yeah, we're a little behind about how much? Probably 6 months, because they started off their hiking cycle in October. They missed a month, so maybe 5, 6 months, 4 to 6 months, something like that. Not quite as bad as Japan. BC, a robust immigration and commodities. We have one bad variable in demographic that is trying to be adjusted for other geography is okay. Yeah, I mean, immigrate. I don't know really the demographics of BC. It's not something I just look at Canada as a whole. And Canada as a whole, the population isn't growing fast. Like, it's growing slower than it grew in the 1980s when home prices were a lot more volatile. And you have to remember that most immigrants are getting paid 30% less than Canadians. They're going for those low skilled jobs. That's why you see them at grocery stores and in affordable housing. And that's not me trying to stereotype people. That's just the facts. That's just the way it is. I've been in affordable housing units many, many times in Toronto. And you only have to look around when you go to different places and look at who's doing those low paid jobs to work it out. You don't have to be a rocket scientist. So immigration is really just a being used to speculate, essentially. And you can use that. You can say 400,000 immigrants coming in, keep buying, keep buying, keep buying. And then eventually it gets to a point and everyone's like, what's happening? Why aren't the prices going up? Where are these immigrants? Like, they don't get it. So, yeah, it's kind of, oh, yeah, the bubble started in 2006. I'm not counting the pre-dip period in 2008, but the dip was small, about 5%, then an insane increase. Isn't that ironic? Because that's exactly the same as what happened here in Canada. So how can you have two countries so far apart, so different economies, and exactly the same thing happening? And if you look at China, it's the same thing that happened there. And what's happening in China, folks? That was even more speculative than the Canadian housing market. So, and it's kind of weird that we're drawing comparisons with China, but there are a lot of just quite frankly disturbing comparisons with Canada and China at the moment. Commodities, no tech, basically property, transport, ports, airport, transport companies. In fact, yeah, so commodities, same sort of thing as Canada, probably on a larger scale. Main freight has been a stellar performer for a few years, from dust to $100, now back to, yeah, smash that like button. Thanks, Trent. We need to get long soup lines coming. Yeah, I mean, well, just look at the gas stations. Just look at the gas stations. They're basically the soup lines. They're the new soup lines. And I'm going to Costco tomorrow. A guy was Florida Ray. If you're in there, make yourself known. But Florida Ray sent me an amazing clip, loads of good information about what's going on down in Florida that he wanted to include in a video. And I'm going to include my part as well about what's going on up here in Canada. And again, you're going to draw these big comparisons, and they're two completely different places, two separate places. And when things start to move in tandem, like 2008, well, prior to 2008, it's not a good thing, guys. It's not a good thing. I tried to turn the volume down on my forecast because nobody takes them seriously. Yeah, that's what I say. Gonna live in my Tesla. Well, that I hope the seats are comfortable in there. I know they're quite roomy, that's for sure. But they are not numbers. Plus, I plucked out of the air when I say 78% decline. I'm massaging that estimate to allow it to seem possible. I fully expect markets to end in the singles percent. Yeah, it's going to be incredibly insane, because that's your downside risk in Canada as well. So it's kind of insane. So and it's hashtag Scott Walters. Yeah, I wonder if he's in there as well. But yeah, provincial centers down 6% in the month on the North Islands, and I think I also saw Wellington. These big cities as well. That's probably what you're talking about. But these big cities are they're declining in price as well, and they were the big booms. So it's going to be timber. Yeah, it's coming. It doesn't matter what you think, it's coming. As long as those rate hikes keep coming, as long as that inflation keeps coming. If that all changes, then yeah, we'll come back and readdress what's going to happen. But at this point, the probabilities of inflation going down, tiny. The probabilities of interest rate hikes stopping right now, tiny. So there's no point talking about that. It's a waste of time. Anyway, guys, David, thank you so much. I'm so glad we had you on this live stream. Thank you for being here. Trent, the Canadian Real Estate Show, Greg, thank you all. Dark Horse Gold, I saw you in here. Jason Pepper, all you guys, thank you so much. USB in first try, thank you again for that super chat, and the chat that we had after that was very, very productive. If you haven't done so already, like this, because the YouTube algorithm is going to pump that out to the top of people's feeds, and then they're likely to see this highly educational video and discussion. You know, when we eventually get to a point where I buy this streaming software, we'll have you guys that want to come on. You can come on live and we'll chat. And I think that'll be much more interactive than just using the chat. But anyway, guys, thank you so much. Enjoy the rest of your evening or morning in New Zealand. And I will see you guys in the next stream. Take care of yourselves. Peace. And the video tomorrow, by the way.